Hello and welcome, I'm Sayash Maheshwari and you are watching Last Tick here on News 9, where we bring to you the lowdown of the day's action on the last read. And Indian markets, they continue to stage a strong recovery for the second day on the trot as Nifty surged nearly 1% to end above 22,300 for the first time since April 12. In the last two sessions, Nifty has now recovered over 550 points or over 50% of that entire 1,000 point drop from the record high of 22,775 to the April low of 21,777. What's more, the index now managed to close above the 40-day exponential moving average, which is placed at 22,196, and the 20-day moving average placed at 22,313. In fact, if you look at the day's low today, it coincided with the 40 DEMA, which will be a crucial support for the index going forward. On the upside, 22,394 and 22,562, which are nothing but the 61.8% and the 78.6% retracement level of that entire 1,000 point drop from the record high to April low, that becomes crucial resistance areas for us to track. And for the proponents of technical analysis out there, Nifty by the provisional close today had formed a hammer pattern following the Friday's piercing pattern. Each now is a bullish signal on its own, but together they suggest an even stronger sign that a pullback might keep continuing from here. A piercing pattern followed by a hammer usually means a strong shift from the downtrend to an uptrend, indicating that the buyers are stepping in and the market mood is turning from bearish to bullish. Will it? Won't it? That we'll see. We'll have to see follow-on buying from here on. But again, keep in mind the 40-day exponential moving average, which also was today's low. I think that will be the key for us to really continue recovery from here on. And talking about recovery, let's talk about the factors that led to it. Apart from the technical indicators, it was the global cues, or I must say the lack of it, because the biggest risk for the market going into the weekend was what Iran was going to do after Israel's retaliatory attack on it on Friday. And since most of these attacks in the West Asia have happened around the weekend, the initial attack on Iran's embassy in Syria, Iran's response last week, and the Israel's retaliation to Iran's retaliation, the markets were especially nervous, and that we saw in the performance of the Wall Street. But since there was no further escalation, perhaps the market is looking at it as a sign of de-acceleration. Joining us on the show now is Mr. Rohit Srivastava, founder and market strategist at IndiaCharts.com. Sir, thank you for giving us time here on News 9, and what a time to have you, because phenomenal recovery, and I think most of us are surprised by the kind of 550 point move we saw in the last couple of sessions. What are you making of this recovery? Is it just a technical pullback, considering the markets were in oversold territory and FIIs were aggressively net short in the future segment? And if that is the case, do you expect the market to test the recent low once again?
So mix of things there. First of all, it did get extremely oversold on the very, very short term. We measure that with a couple of diffusion indicators. We look at our own RMI indicator, and when we look at that across the F&O basket, we found that there were only 5% of stocks showing positive momentum, which means 95% of stocks were in negative momentum, and that is what drove this rebound from Friday's low. Now, we do think that this rebound might only be a counter trend move, which means only a dead cat bounce, retracement, whatever we may call it, a large part of which has been done today, because we are almost close to the 61% mark, whether it's around 22,400 for the Nifty or 48,100 for Bank Nifty. Barely around 70-80 points more left for the Nifty to do that. Even if it does slightly overshoot that number, if it does 66%, say 22,430, that also would be fine. But main point being that it will end at some retracement and not really go back to new highs is what I think right now. I think we will head back towards the lows. We'll see whether that happens over the next couple of days. But the reasons are that it's not just the geopolitical factors. That's probably the easing of that has definitely helped the rebound. But what is going to come back and haunt us is what was the real reason why the US market started to correct more than a week ago, and that is rising bond yields. And I think we'll go
Right.
back to nothing has changed there. Bond yields are sort of flat for the last 3-4 days. They haven't really gone down. The risk is still that they will head higher. And I think moment that starts happening, the markets will start pricing in higher rates into the valuations of the market. And I think that is what the risk is, I think, right now.
And interesting that you bring up, the higher and the rising bond yields in the US, because, one of the things I think that got lost in the correction last week because of what was happening in West Asia was the commentary coming in from the voting members of the US Federal Reserve. I mean, in the last 1 month, we have a complete swing around, sir. Like, we heard Mr. Powell after the last policy meet, he came out and said that maybe the dot plot, at least for now, is indicating 3 rate cuts. From there on, there were a couple of voting members who said maybe, we should hold rates higher for longer, and there might be rate cuts, but maybe towards the end of the year. Now we had the New York Fed Fed voting member come out and say that perhaps we'll have to look at hiking interest rates instead of cutting rates at all. I mean, what's your overall assessment of the situation going on over there as far as monetary easing is concerned? Are we going to see any rate cuts at all, or do you foresee any rate hike from the US?
So there's a theory which says that the Fed follows the bond market and not the other way around. Which means if bond yields are rising, eventually the Fed ends up raising rates. If bond yields are falling, eventually the Fed ends up cutting rates. But the Fed will try to use its monetary policy to direct rates in a particular direction. And sometimes they do that simply by using language. So what I'm here trying to say is that between October and January, we actually saw bond yields come down a bit, and the Fed started to talk about cutting rates.
All right, all right. Sir, we'll come back to that in just a while. For now, it's time to take a short break, but please stay with us as we have lots and lots to discuss with you on the other side.
Golf as a game, it is closest to the game that you call life.
You've got to use your mind. You cannot lose it.
The sharpest person is one who understands his limitations.
खुद ही को कर बुलंद इतना कि खुदा बंदे से पूछे कि तेरी रजा क्या है.
You might have a bad break after a good shot. You might have a good break after a bad shot. But the fact remains, you got to play the ball from where it lies.
Watch Jeev Milkha Singh on Duologue with Barun Das, streaming on News 9+.
Why is the state not looking at putting an embargo on that?
As a Telangana person, I will not accept.
How do ordinary folks deal with this?
The football is mother of all games.
It is a team sport.
The leadership attitude is taking the ownership.
It's always a big responsibility to take decisions and the right decisions.
I always question the stereotypical.
And that's why you are in that position.
This and more. Streaming on News 9+. Subscribe and get free vouchers.
Welcome back. You're watching Last Check here on News 9, and I'll come directly to you, sir. Rohit, what are you making of oil price? I mean, do you think that they have made a near-term top at around $91 a barrel? I'm talking about Brent here, because time and again, whenever we heard stories or reports of escalation in tensions in West Asia, oil Brent would get to $91 a barrel, but whenever there was a news of de-escalation, it would fall and come back to around that $86, $87 a barrel mark. What's your assessment of oil? Has it made a near-term top?
So we've already seen the correction, I think, from the near-term top. It's pulled back now. And therefore, I think we are at a support closer to $82 and might start heading higher again. That is the scenario. If you look back, this up move in oil started from closer to $70. It did not start because of geopolitical reasons. So right now, the geopolitics is having a limited impact because it's really not resulted in anything which directly impacted any sources of oil, any refining or any oil wells somewhere. So that has not really been the issue, which is why you quickly saw a correction in oil prices. But now that they are at support, I think overall the trend for oil is still higher. We may head back to $90, maybe even above that. I'm not ruling out that you go into triple digits. And so we would actually be bullish on oil from, $82 support.
All right, and we are also in the midst of the earnings season. Just wanted to get your view on the results of HDFC Bank and especially the more than 3x jump in provisions. I mean, according to the management, that is to make the balance sheet more resilient. But I was reading some of the reports out there. Some of the brokerage houses have raised concern that maybe the retail and the wholesale segment, because the margins dropped significantly, there are signs of caution rising over there. And others have even said that maybe there is some earnings smoothing going on, considering that NIMs could be under pressure even going forward, since we may not see monetary easing anytime soon. What's your assessment, especially this this significant jump in provisions for HDFC Bank?
So I can't really give any advice on HDFC Bank in particular, but broadly speaking, it's been an underperforming stock. It's also been the private banks like Kotak Mahindra, etc., which have been underperforming, and all of which because of the previous run over ownership that ended up happening in the last cycle. And that unwinding has sort of kept them under pressure. So every time there's a slight positive or negative news around these stocks, I think they tend to see quite some volatility in both directions. Though it may appear surprising that post the results, there wasn't a very big move in the price of the stock as some people were anticipating yesterday. And that shows that, to some extent, these so-called negatives are being discounted by the market as of this moment. But essentially, I think the stocks are going through a long consolidation phase because of the over ownership that actually ended up happening.
All right, and also wanted to get your view on the IT pack on the whole, sir, because I mean, looking at the management guidance that has come out, apart from TCS, the guidance, the forward-looking guidance from even Wipro, Infosys, and even Persistent today, I mean, they are expecting pretty much zero growth as far as revenue and margins are concerned. So, FY25, another poor year for our IT companies.
Yeah, it looks like that, at least from a price performance basis. I think we'll remain bearish on the tech sector. It may appear to some people that short term it is getting oversold because IT stocks have been falling for the last 3 months or more, almost from the peak that they made, and there has been relentless selling. So at some point of time, what you end up getting is a technical bounce. But the guidance that has come up has sort of is coming across as a deeper shock than we really thought. And it somewhere reflects on this whole global demand story, right? Because one side we hear that, the world economies are doing well and, the demand environment is strong. But if that is true, then why is it that the tech sector, which is extremely correlated to the global economy, actually underperforming, not just in India, but also in the US? And so I think it has become a troubled spot. The structure has sort of broken down, which means that you are likely to see further poor performance from IT stocks for the months ahead or for the rest of the year, in fact, I would say. And so that's a sector that is now an avoid, I think, for 2024.
All right, IT is an avoid, but what's your general assessment of the earnings so far? We have not had too many. HDFC Bank among the large private banks has come out. IT companies, we have had quite a few of them come out with their numbers. What's your assessment? Any hits and misses that you have picked up?
So we are looking at earnings really slowing down a bit from what we saw in the last 2 quarters, where the Nifty earnings growth was almost at 30%. It dropped to 22-25% in the last Jan quarter. This quarter it may go sub 20, is what I'm thinking. So there's very mild slowing down of the growth rate, but the growth rate is still quite a positive, which is the good news. What is the concern really is what we started out discussing in the beginning, is the impact of higher rates on valuation. So I think that's the mix we are dealing with, but growth still appears strong, numbers still appear to be good. even though they're slowing down on a quarter-to-quarter basis.
All right, growth seems to be slowing down on a quarter-on-quarter basis. But, sir, I mean, what a wild ride it has been in the last 1 month. Nifty has gained 1,000 points, lost 1,000 points, now recovered 500 points. The ride has been quite choppy. I mean, and also we are in the election season. Polling in the first phase of polling has begun, and then we have multiple factors. The West Asia, the tensions going on in the West Asia to look forward to. Politics, elections in the US as well. I mean, for the next 4-5 months, what would be your advice for retail, the small investors out there? I mean, how should they, go about about dealing with the markets at this point?
So I think this entire move that we've seen since January, these gyrations which you're talking about, 1,000 points up, 1,000 points down, they essentially, I'm calling it a distributive phase. So a lot of stocks are stopping to perform, while few stocks may have done well, like the metal sector has done well. But many others are actually breaking down, whether it's FMCG, whether it's IT. And so my sense is this distributive phase probably comes to an end, and you'll see relatively more selling in the weeks ahead initially, probably running into the closer to the election period before the result announcements actually happen. And mostly on global risks. I think the global risks are the bigger reason. Of course, once you get close to the result announcements, there is a possibility that there will be one election rally, because that's what we've typically seen the last 2 times that the market rallied into the news or outcome of the election results, which is very strongly anticipated to be a all win for a single party. So you see that pattern, sometime, but broadly that means a lot of volatility. But I'll say it's going to increase in terms of points. What we've seen, 1,000 points, you might end up now getting much wider moves in terms of trend in both directions.
All right.
You need to really be prepared to deal with that.
All right, and a bit of a contrarian view coming in from Mr. Rohit Srivastava. Earnings growth are likely to slow down, and we are likely to see more selling before the follow-on buying takes up. But that's all we have in this edition of Last Week. Thank you for watching. We'll see you at 9:45 on First Tick tomorrow. But coming up next is Business Plus.
Currently, the industry is facing a lot of challenges as far as demand is concerned. Basically, the US markets has slowed down.